Good afternoon, everybody. Welcome to the BioBreak panel discussion on current life science trends, IPOs and SPACs. My name is Bryan Snellman. I'm an audit partner with Ernst & Young. First, want to thank the BioBreak organization for setting this up. Laura Sullivan and Sam Wolf did a nice job helping us out to get this organized. So thank you to both of them. Little quick introduction on myself. So I'm an audit partner in Ernst & Young's Philadelphia office. I've been with the firm for about 18 years now. Most of that has been spent working with life science clients in the audit practice. So there's a team of us in Philadelphia. There's about 4 partners, myself, Steve Simpson, Jason Frederick, Amy Dorfmeister, to name a few, who spend the majority of our time serving life science audit clients. We have about 35 life science audit clients in the Philadelphia office, 15 a public company. 4 of those have become public companies just in the recent months. So a lot of upcoming activity as well with companies that are looking at the IPO or SPAC path. So I've had a lot of experience in this topic we're going to talk about here today. So for those of you from the Boston area, our EY team up in Boston, I'm sure many of you know Mike Donovan, Chris Pereira, Pam Kelleher, to name a few. Our Boston office is the clear leader in the life sciences industry up there amongst the big 4. Huge list of public and private clients, audit, non-audit services. So, and then nationally, Ernst & Young is the leader amongst the big 4 in auditing the Fortune 2000. And we've been the leader in life science IPOs nationally, auditing over 45% of those since 2018. So I'm looking forward to getting more involved here in the BioBreak organization. Looking forward to hopefully meeting a bunch of you on this call today. And now I will kick it around to the rest of the group here so they can introduce themselves. So John, do you want to go first?
Great, thanks, Brian. Thank you to the BioBreak folks as well for the invitation to participate. My name is John Civitarese. I'm a managing director at SVB Leerink in the Biopharma Investment Banking Group. I am headquartered in Boston. I have been with the organization, the Leerink organization, going on 26 years, with 23 of that in banking capacity, and work with emerging growth companies across the spectrum of stage of development, financing stage, as well as therapeutic category. So.
Rachael, you want to go next?
Sure, thank you. Good afternoon, everyone, and thanks to BioBreak. My name is Rachael Bushey. I am a partner at Troutman Pepper, and I chair our health sciences department. My practice is solely focused in life sciences in both M&A and capital markets, and I'm really looking forward to an active discussion today.
Hi, good afternoon, everyone. My name is Condola Brivitte. I am a senior manager at Ernst & Young. I have been with the firm for the past 11 years. I've been working on SPAC transactions for the past 4 to 5 years, and I'm looking forward to this active discussion today.
Well, thanks, everybody, and thanks to the 3 of you for being on the call here with us. So with that, we'll dive right into this exciting topic. So current life science trends, IPOs and SPACs, and we were catching up before this call that there's no shortage of topics to discuss here. So a lot of recent activity coming out of the SEC, but really first wanted to kind of kick it off and just talk about the current market conditions, really specific to life sciences. But John, maybe you can kick it off here. Talk a little bit about recent market conditions, specifically what you've seen within life sciences here in the first few months of 2021, and what is your expectations and outlook here for the rest of the year?
Sure, thanks. I think overall, we are quite bullish on the sector as we think about it holistically. This is a continuation of really a bull market since 2012, with several interruptions that have occurred. Some of them longer than others, such as the back half of 2015 into 2016. Others much more short-lived. But generally, the trajectory continues to be upwards, and we believe that'll continue. With respect to 2021, we have seen some disruption and volatility over the course of the last, call it 6 to 8 weeks. If you look at the XBI, it reflects a rotation out of the sector. Whether that rotation continues or stabilizes, I think is a little bit yet to be seen, but we're down about 23% from our high in, I think it was around February 8th. That is not the low. I think the low was around 30%, so we have recovered a little bit, but we do continue to see some volatility in the sector. That said, we also continue to see very high quality deals get done both on the IPO as well as the follow-on landscape. Excuse me. Most of them are pricing well. Aftermarket performance has been mixed, and that's not surprising when we see a rotation or some rotation out of the sector. The quality screen gets significantly more rigorous, but again, lots of money in the sector. Deals still getting priced, just more with a bit more selectivity. As far as the rest of the year goes, we do think high quality companies will continue to get capital put into them. They may be more clubby like transactions, so maybe not as broadly subscribed, but we do envision continuation of funding, strong funding throughout the rest of the year. That's
great, thanks, John. One thing that obviously is a current hot topic here, but interested in your perspective as well, is just the historic spike here in overall SPAC activity here in 2020. And maybe John, you can just start, and then Rachael and Condola, you can chime in as well. But can you talk a little bit about why the SPACs have become so popular here over the past year or so? And I guess this is an ever-changing question, but do you expect that trend to continue, or is it a little uncertain?
Yeah, no, and it is certainly a bit of a new vehicle to us, and we're all getting used to it. But I do think it is here to stay. To be clear, maybe not at the rate that we're seeing them. To put it in context, and folks that have been around a while. We had a SPAC boom back in, I guess it was probably 2005, 2006. However, those were not the SPACs that we're looking at today. These were, for all intents and purposes, shells that were put together by typically oil and gas lawyers down in Houston that would try to really just reverse merge biotech companies into them. They did not have strong sponsorship. They did not have strong subscription from investors that bought into the IPO itself. This is a very different class of SPACs. These are mostly sponsored by really the tier one healthcare dedicated hedge funds and increasingly the venture capital firms as well. So the rigor that goes into vetting the opportunities that get merged into the SPAC is of the highest quality. And I think that kind of peer review, for the lack of a better term, brings validation to the investors that have invested in the SPAC to stay in it after the de-SPAC transaction. So I do think they're here to stay. This is really just the next evolution of the crossover round for all intents and purposes. What we've seen since 2014 is really crossover rounds becoming not just the norm, but 95% of companies that go public, or somewhere around 95%, have done a crossover. And this is really just a continuation of the healthcare dedicated hedge funds who have enormous amounts of capital extend what they've done on the crossover side and company creation to really getting them out and liquid, really without the assistance of the venture capital world.
Yeah, and I think that's a really good point, John. Companies are viewing this as a quicker way, obviously, to be in the public markets because they don't have to do the first step crossover and the second step IPO. So I think they look at it as also, they may or may not be engaging a banker in this process and, could save money on that end. Although I do think they need to be careful of the valuation that they get, the amount that the sponsor shares has, any kind of warrants and aftermarket trading. But certainly the caliber of SPACs in the life sciences field has picked up. And so I think, the amount of them as well. So I think we're seeing them, obviously be very active and will continue, I think, to be active throughout the year and years to come.
Thanks, Rachael. I appreciate that. And then, so Condola, we've talked now about SPACs and IPOs, and I know, one of the questions that I get a lot from clients is, can you tell me a little bit about the difference between the two paths, right? So what's so different between SPAC and IPO? So can you spend a couple minutes, Condola, and just put some color to that and explain really what are the key differences kind of between the two processes?
Sure. The major key difference really is going to be the timeline. That's the one that we see often, and that's often discussed. An IPO can take up to like 24 months to get that IPO completed. In a SPAC transaction, while the SPAC has a limited life, it has 2 years typically to complete the deal. From the time that that SPAC signs an LOI to the close of the deal for that private company to now become public, it can take typically anywhere from 5 to 6 months. So the timeline to close is one of the things that is a difference between the two. There's also, when you're looking at the structure as well for the SPAC in comparison to the IPO, the filings are being done by the SPAC, or if a new co is created, the filing is being done by that new co in comparison to the IPO, where the filing is being done by the operating company. So.
The other thing I would chime in there too is obviously you have the negotiation of the merger agreement with the SPAC entity, as well as, on the typical IPO, you're filing it on an S1. In a SPAC, you're doing either an S4 or a proxy statement. You can usually get through the SEC a little bit quicker with an S4 or proxy. I think proxy tends to be a little bit quicker, just there tends to be less SEC review on that. Although I'm worried about saying that, and then God forbid we turn around and the SEC seems to be making statements every day, so that could change quickly. But you can usually get through that registration process a bit quicker as well, because you file the proxy or the S4. Then obviously you have to clear comments, and then when you have your definitive or you go effective, then you typically file that about 20 days before the stockholder meeting and close on that same day.
Before I go to the next question, I do want to mention to those of you in the audience, if you have questions that you're interested in asking here, you can use the chat feature in Zoom and put those in, and I'll monitor those throughout and work those in as best as I can. Some of you did submit some questions before as you signed up for this, so I'll try to sprinkle some of those in here as well. And this next one was one of those, but it was related to the redemption risk. Within the SPAC process, and really how significant is that risk, and has it been common for life science SPACs to see investors exercising those rights? So I don't know if Condola, you want to take a first shot, or John?
I'll just
let John go first.
Yeah, I'll just make a quick comment. I think that gets to I think the redemption risk is relatively low. Whether we start to see that increase now with a rotation out of the sector, or macro concerns about the market, that may increase. But to my previous comment about these de-SPAC targets that are getting merged into the SPAC and being, for all intents and purposes, viewed by the smartest sponsors, the investors in the SPAC are the equally reputable and smart investors in healthcare as the sponsor is. And if you look at the sponsors versus the investors for any of these, you're going to see a significant overlap. So I think the redemption risk for high quality sponsored SPACs is relatively low, because the folks that are in it as an investor know that the rigor of the diligence process that will go into choosing a de-SPAC target is of the highest quality.
And I'd just like to add to that, John. Very good observations. The one thing that I'd like to add is that the SPAC sponsors are trying to backstop that risk by getting what we call private placements, which are the pipes, to help also backstop the redemption risk. So if they feel they will get additional funding during that deal to make sure that if there's a larger than expected redemption towards the tail end of the transaction, it's kind of funneled by that private placement.
Yeah, I think that's really key. A couple things in the SPAC process are, number one, the valuation of the target company, and relative to the valuation of the SPAC. Number two is the minimum cash that you, as the target, negotiate to have in the SPAC. So while I completely agree with John, redemption risk is relatively low, but you want to have a minimum cash, and if you can, as a target, negotiate that, not include the pipe, so that the pipe is solely the upside. And then thirdly, obviously making sure that you have a strong side-by-side pipe, and that in that pipe, you're getting really quality blue chip investors, because you want to make sure that your aftermarket is still trading well. And unlike an IPO where you have the investment bankers really helping you through the pricing process and looking at demand and engaging demand, and really, I think, doing a really good job of ensuring that aftermarket is going to go well. You don't have that same kind of quote unquote protection or analysis always in a SPAC. And so making sure that you do a really quality pipe, I think is key. I did see someone just ask what a de-SPAC process was. So I'm just going to answer it quickly. That's the process through which you take the shell company and you transform it into the actual merger of the target company. So the whole process that we're talking about of the merger is the de-SPAC process. So that at the end, you're a combined entity and you're no longer the SPAC shell entity.
And with that, just to make sure everybody understands, maybe you can just explain a little bit too about the SPAC structure and the redemption risk concept, right? So everybody's kind of understands exactly what that means.
Sure. We tend to think about the SPAC cycle as like 3 definitive portions. So you have that they've now IPO'd and they've gone public. The second part is you're now searching for a target and you're going through the actual deal and SEC process. At that de-SPAC date is now when you've combined with that target company and you now need to stand up as a public company. So the way that the SPACs are set up is that all of the public shareholders have what they call a redemption right, which means that you as a public investor in a SPAC has the right to redeem your shares from that SPAC prior to the vote date. It's typically, there is a cutoff date for redemptions, and that's usually 2 days prior to the date of the vote for the transaction, and you're able to submit a request to redeem your investment from the SPAC. And that's what we mean by redemption. And these are the public shareholders on the SPAC side.
And the other piece on that also is just a nuance there that while you can redeem your shares, you can still vote in favor of the transaction and then redeem your shares.
And then we have a question in the queue here just about the dilutive effect. And John, maybe you can hit that, but is going public through a SPAC less dilutive than going through a crossover round before going public through an IPO?
Yeah, they're essentially the same, right? You're going through 2 steps in which dilution occurs versus 1. We think they're analogous. So they're roughly the same from a dilution perspective. There's a couple other quick questions. Can a SPAC start searching for the target? Not until after they price. That would be illegal. So I would just say that. A couple of this. Somebody had asked whether this is the same as essentially doing a reverse merger into a cash shell. I think there's similarities here, but with a SPAC, you're inheriting, typically in today's class of SPACs, you're inheriting a significantly different shareholder base. The shareholder base is going to look more like a traditional IPO versus a reverse merger.
Yeah, and there was one more in here, John. I know we had talked a little bit about too, but just general, size of SPACs and, for life science companies, obviously ranging in valuations from that are doing IPOs in, the $50 million range to much higher. What's the general size of SPACs that we see right now in the market?
Yeah, they vary in sizes. You see smaller SPACs in the kind of the 40 to 50 million. And then you see much larger ones, 300, 400 million. That's going to be a function of obviously necessary capital, right? Or use of proceeds, and whether that amount of capital is the right amount of capital for the company to achieve value creation. But it also speaks to valuation. And somebody had put a question in here about kind of 20%. Well, there is a 20% reward to the founders. What do they get for that? They put at-risk capital up. But separately, there is a requirement that there's an 80-20 split on the equity portion. So just think about $100 million SPAC. The de-SPAC target would have to have a valuation of at least, call it 80 million. So the higher you go up in your cash available, that's going to obviously be commensurate with valuation as well.
Yeah, so while we're talking about SPACs and valuation process, John, can you talk a little bit about just the process of attracting a SPAC? I know from a traditional IPO perspective, you go into selecting bankers and a bake-off and those sorts of things. So how would a life science company, go about attracting a SPAC investor?
Yeah, my own perspective is I look at SPACs as really just another source of capital, so similar to another fund. I would run a SPAC search transaction in the same way that I would run a crossover transaction. I would reach out to the sponsors and I would try to get a meeting and assuming that the criteria that they're looking for matches what my client is doing. Other than that, you wouldn't want to waste anybody's time with that. But assuming that they were, you try to set up a meeting just like you would with any other hedge fund or mutual fund. They're incredibly competitive. Just to be out there, to put that out there. I think the idea that, I'm a private company and I'm only going to do a SPAC, that is a challenging prospect, quite frankly, because I think every SPAC is looking at somewhere north of 80 to 100 companies. They have the money, so they are in the driver's seat as you think about the process. That said, we are running multiple SPAC searches in parallel with crossovers. And I think, ultimately you'd love to get a term sheet from a SPAC and you'd love to get a term sheet from a tier one hedge fund. And then you can compare the two and understand what is best for you as the company. But it's incredibly competitive. More and more banks are being hired to run those processes, I think, because they are competitive. So for instance, if you were to hire my firm to do it, I go into a SPAC sponsor. The sponsor will look at it and say, okay, XYZ company has SVB Leerink as their bank. They presume that we have vetted the opportunity and the science and that there's likely to be aftermarket support, i.e. equity research coverage on the back end, versus somebody who does not have a bank, who will have to build that support via the D-SPAC pipe most typically. So I do think there's some benefit there, particularly in such a competitive environment. But they are highly competitive, and I think about them as just another source of capital, as we would a crossover universe.
John, I think that's true. I think the one thing that companies, because the SPAC craze has everyone very excited, is that sometimes they don't spend as much time thinking about their strategy and their story as they would before presenting to a high-level crossover or a bank for an IPO. And I think one of the benefits of hiring a bank that we've seen for our companies is the banks help them craft that story before they go to the SPAC, so that they don't go to the SPAC, as there's only one time to make a first impression, too early, right? Because it is much more competitive, I think, than people realize. And I think some of the companies don't know about all the different SPACs, and B, they don't think about the strategy and story that might be really resonating. Whereas you guys, I think, can come in and help them. And because it's so competitive, they get in front of more SPACs and their strategy and story is better, and which then obviously helps them as they go through the D-SPAC process in any event.
I think that's right. We do prep companies in the same way that we prep them for a crossover. We work with them diligently on the deck and the messaging and the positioning. So I think that is right. You're right. You only get one shot at it. It's a great point. When the SPAC sponsor is looking at somewhere north of 80 different opportunities, if you don't make a good first impression, you're climbing a big hill.
There's a lot of questions of, should I SPAC or should I IPO? I think you answered that a little bit there, John, by saying that, if you're just going to say, should I SPAC, that's probably a tough route to take. Rachael, can you talk a little bit just about, some of the, from your perspective, the risks and benefits of IPO versus SPAC, as our audience is thinking through some of those alternatives?
Yeah, I think, obviously we've seen a lot come out from the SEC on SPACs, and while it is a quicker path to becoming public, there are some disadvantages once you're public. You can't incorporate by reference into an S1 for 3 years. You're an ineligible issuer. You can't use a free writing prospectus. You can't use certain safe harbors. And while I find that companies really, when I say that to them, they don't much care in the beginning, right? You will care because it's all about your access to capital on a post-closing basis and how easy it is to do that. But both SPACs and IPOs can't use an S3 for a year after IPO or SPAC. So there are some considerations that the SEC has made it a little bit more difficult on post-closing SPAC companies. I think if you have the opportunity, though, to merge with a SPAC that has blue chip investors and you have a good valuation and have a strong side-by-side pipe, I think, it can be just as good as an IPO. It could be, potentially cheaper to get there, potentially quicker to get there. So there are some benefits. I just think what I see a little bit sometimes companies make the mistake of doing is they get really excited about going public and they want to move as quickly as humanly possible without thinking through some of the same things that you would be forced to think through in an IPO. So in an IPO, you sit down for 5 weeks with a whole team of advisors and you go through line by line your business section and you think through your strategy, because that is what you're going to have to live with post-closing in either an IPO or a SPAC. You don't have that rigor in a SPAC process. And so I find that companies are not spending enough time thinking through their business section and their story and their strategy. And that lives with them post-closing, because you can't turn around and, in your next Q, wildly change your business section. So I think they're both good alternatives. I think companies have to be disciplined and diligent in doing a SPAC and making sure that they put that same time into thinking through what you would be forced to put the time into through an IPO. I think that's one of the benefits of hiring a banker. I know companies at that stage don't want to spend the money, but I think that I've seen it really help them on a value standpoint, in an aftermarket standpoint with analyst coverage too.
So you hit on some good points there from a legal perspective, obviously in the business section. For the CFOs and controllers and others on the call, Condola, can you talk a little bit about some of the just accounting and the accounting complexities within the SPAC process, and what it takes to deal with some of those?
Yeah, so similar to what Rachael was saying of being able to make sure you have a banker, it's the same thing from the accountant front, making sure you understand the accountant implications of certain areas that's popping up in a SPAC. We've obviously touched on the warrant issue that popped up recently with the SEC, but other items that's in that SPAC merger that you need to understand is going to be, are there earnout provisions in the SPAC transaction? How will that get accounted for post-close? Do you have a complex stock compensation plan? How do I simplify that to be more in line with other public companies as you're going through the merger? But just from an operating company standpoint, one of the things to also consider is operationally, are we staffed properly for the accounting department? Because post-close, I now need to comply with all public company requirements. Am I staffed properly? What plan do I have in place to make sure we're ready to comply on a basis that's probably faster than your current close process? And that's one aspect of it. The other one that most private companies always bring up is compliance with 404. And when do I need to comply? What release do I have available? So all of that you need to start thinking about upfront. And once you've identified a SPAC that you're going to merge with, you need to also understand how that SPAC interplays with that and the timing of your transaction close for 404 considerations. So those are the big ticket items, especially the 404 considerations for most accounting departments. That's the concern of their staff, is how quickly do I need to comply with that?
Yeah, that's a great point. And can you touch on a little bit, for a lot of the early stage pre-revenue biotechs, they'll file as emerging growth companies and get that relief under the Jobs Act. Can you just explain what the EGC status is as far as a SPAC?
Sure. So you have the relief from getting an auditor's opinion on your control environment. So you do have that relief for the 5 years that's allowed with the EGC. That 5 years also include any time period from the SPAC's IPO. So you need to count that as well. So when you're going through, you'll consider doing that, but you need to start getting SOX ready and understanding where does your actual operation stand. I think a lot of people delay that understanding of where their company is as far as SOX readiness, and then wait until the last minute to comply with being ready to comply with all the SOX requirements, you're still required to do all of the other requirements. It's not just the auditor's report, but you still need like the CFO certification, the CEO certification that occurs with all of the periodic reporting.
And on that, in addition to kind of the management's assessment over internal controls, I also, companies need to spend the time to make sure that as they're going public, it's not just the access to capital, but they're ready from a disclosure control standpoint, that they're ready from a compliance standpoint, right? And it's not just paper compliance, it's making sure, once you negotiate that merger agreement, putting together a board calendar of every 2 weeks, tackling different policies to make sure you have all the right policies, to make sure you are recruiting and hiring the right people, so that by the time that you actually are public, you are ready to go from that standpoint, and you're not jumping, having all these hiccups right out of the gate.
And Rachael, there's a question here in the queue about, targets for SPACs. Targets can make forward-looking statements about the number of years out. I know that something came out of the SEC last week with regard to liability and forward-looking statements. Can you just sit on that one?
Yes, essentially, that there used to be some practitioners who would say that the targets didn't have liability for forward-looking statements. The SEC has clarified that they would have liability for any forward-looking statements that they make, that they should be careful not to make projections. As we've seen the SEC come out, as we were kind of joking on the call earlier, it seems like every other day they're coming out with additional clarifications to make sure that SPACs understand, and I shouldn't say SPACs, target companies understand that as they are putting their disclosures together in the proxy or the S4, that they have the same liability that the public combined company would have for material misleading information, and that for any forward-looking statements, and that they need to be careful not to make projections.
As we can use that as a good segue here into talking about SEC trends, but that statement, I know a statement came out last week from the SEC, regarding these forward-looking statements. Let's stay on that one quick, Rachael. And, just as far as a process perspective for, say current SPAC transactions in process, is there an expectation of delays anywhere from any of this, or is that just more of an understanding, and we'll call it a warning from the SEC?
Yeah, I think from that piece, that was an understanding and kind of a warning. I think most of us who are doing these would already have expected to pick up that liability, and certainly wouldn't be trying to rely on that. And in any event, you're trying to get your companies ready to be a public company, and as it were. So you wouldn't be trying to rely on nuances like that. The one area, and I'm sure Condola could talk about this, that we are seeing is the new rules on the warrant classification that is delaying some of our SPAC transactions. So Condola, I don't know if you want to chime in on that.
Sure. So historically, all of the SPACs have classified the warrants that they've issued. So when a SPAC goes through the IPO, typically they are selling an IPO unit. That consists of shares and some form of warrants. And then we call those public warrants. Concurrently with that IPO, SPACs tend to also do a private placement, and it's often the sponsor where they're completing a private placement with a sponsor to buy what we call private warrants. And the major difference between the private and the public warrants are that the public warrants are typically redeemable by the SPAC if it hits a certain share price. Is that nuance? And then also for the private placement warrants, they have this feature where the private placement warrants are supposed to be held by the sponsor, but once they transfer from the sponsor to the SPAC, once they transfer from that sponsor to anyone else, they become like the public warrants. So that's historically how the warrants have been structured. Both set of warrants have been classified as equity on the financial statements of the SPACs historically. Now the SEC has come down with, they believe that certain of these warrants should now be getting liability classification. The implications of that is that every reporting period, those warrants will now need to get fair valued, and any change in their value will now need to be pushed through the P&L. And this is a major change from the SPAC. So the SEC is requiring all of the SPACs to now go back and assess how material the difference is in the valuation. And they may end up having to do restatements to like their prior filings. And also on the audit firm side, if you are doing like an S4 and you need your consent from your auditor, what we've heard is that the auditors are withholding consent until they have assessed the materiality of this change in the accounting for the warrants on historical financial statements as well as the current deal. So what we're seeing right now is a slowdown in the SPAC market for SPACs that are IPOing, SPACs that are going through current deals, as well as SPACs that have already closed their transactions and they're now operating as a public company. Everyone has paused and is trying to figure out what the implications are for their entities, and so that we can make a path forward.
To clarify too, I think about 90% of the SPAC entities are audited by, two smaller accounting firms. And the way that works is, those firms audit the SPAC entity, prior to the transaction. And then typically, it's a larger, depending on the size, maybe a larger or a big four firm that's auditing the target. And that would then take over once the kind of de-SPAC transaction happens. So we've gotten a lot of communications on it. And I'm sure that these two smaller firms are working day and night, as this just came out on Monday from the SEC. So, hopefully it's a temporary pause here as they get these things figured out. But it's definitely a major item that needs to be considered for these SPAC transactions. So sticking with SEC trends, other than these recent events, any other common themes that have come out lately, just specific to the life sciences industry? Rachael, maybe you can touch on that one first.
Yeah. So what we're seeing a little bit is the SEC is very overwhelmed with all of the capital markets transactions going on. So we're seeing them pull reviewers from offices that are not the Office of Life Sciences within the division, which is resulting in more comments on regulatory pathways, more comments on some of the science, I would call it, and hopefully they're not listening, some odd comments of things that, you wouldn't typically expect from some of the SEC reviewers, I think just because they're not necessarily industry focused. We had, 10 years ago, I felt like we were getting a lot of comments. And then in the last couple of years, we've gotten very few comments. And you would think that because the SEC is overwhelmed, you'd actually be getting less comments, but we're seeing a little bit more comments, but comments that don't appear to be maybe as well thought through.
Condola, anything that you've seen from working with your clients?
The biggest one really has just been more on the operating company side. We've seen a lot of comments coming back for the business section. As Rachael mentioned earlier, they've had comments on the business section. There's lots more still comments for around like stock comp. That's what we've been seeing in the comment letters. But for the most part, it has been trending where there were less comments and now we're getting to more comments, but also the time period. Typically, after you've done that first filing, the SEC is normally getting back to us within like 30 days. And that's still standard. However, like the subsequent rounds of SEC comments have been a bit longer by a few days so far. So that also needs to be factored in the timing. I think before, investment bankers used to tell their clients to only expect maybe like 1 or 2 rounds of SEC comments. And that's not been the case so far recently. So just planning a little bit more timing for the close of the transaction if you do enter one with a SPAC would be my advice.
Or even I think when you're in the IPO, right, we're seeing even in the IPO process, maybe having to go another confidential round before public filing. Yeah. It's obviously the push and pull companies, especially because they, are hearing from bankers that the markets are getting choppy. So there's so much pressure to get through as quickly as possible, but the SEC is overwhelmed. And so they're not shortening any of their timeframes. So like Condola said, they have 30 days on the first round, and then, typically 10 to 14 days on the second and third. And, they try to get quicker as you get through the process, but we're not seeing them pick up a ton of speed just because of how much work they have in front of them.
There were a couple other audience questions that came in here, and John, maybe you can talk to them. There are a couple really just about demystifying, kind of tapping into the SPAC market. One is kind of specific to EU companies, and another one is just in general. How do you find a SPAC?
Yeah, and I can see some of these questions, so I'll try to tackle a few. Irrespective of whether you're in the EU, Asia, or the US, you can access SPACs just like you can access the NASDAQ. So there's no limitation on where you're domiciled. How do you find SPACs? I think there's a couple of questions around that. They file S1s. These are publicly filed, just like an IPO. They are IPOs. So S1 searches can find all of the SPACs. Most banks track them. I don't know if the law firms are tracking them or not, but we track them on a weekly basis. And my capital markets desk sends out all of the S1s for operating companies every week. And along with that, in a separate section is all of the SPACs. So easily findable if you know where to look. I think there was a question here regarding redemption, if there's precedent on redemption. You know, if we go back to 2005 years, people used to redeem all the time. That was one of the problems with SPACs. That's why people didn't do them. I am sure that some shareholders have redeemed in this new class, but it is not what I don't have any specific precedents. I'm not aware of any off the top of my head. I assume that some have. For whatever reason, maybe the fund had a position that they had to cover and they just wanted their money back. But it is a risk, but not a significant risk that we're seeing right now. That may change as the market changes. But to Condola's point earlier, you try to mitigate that risk by doing what we call the de-SPAC pipe, which is essentially a concurrent pipe with the closing of the de-SPAC, of the merger in the special acquisition company. Some folks with respect to valuations on EU companies being more attractive to SPACs, is that an advantage? Not really. I mean, we see EU companies go public through traditional IPOs with significant valuations. So I think the valuations of EU companies have ticked up and aren't necessarily perceived to be lower anymore. And then the last question I'll tackle here that I see is the money going into SPACs taking money away from other traditional private VC funding? The answer would be in some cases, but largely no. The investors that invest in a SPAC are public investors, right? They are the same people that buy IPOs, traditional IPOs. So these are mostly hedge funds and mutual funds. In our particular sector, have healthcare dedicated hedge funds and mutual funds. There are VCs that have started SPACs now, and their investor list is going to look very much like the public universe investor list. So I think the answer there is no. It's not taking away from VC funding, at least not what we're seeing thus far.
And we've seen the headlines of celebrities being involved in SPACs and as well. So I guess the question probably is, is somebody who's really not familiar with it and is trying to, identify a SPAC, right? And you say, hey, they're publicly available. Should they be still talking to bankers and of those sorts of how to access capital? And this would just be one other option that you're talking about with your clients?
Yeah, I think, and again, it gets to the sponsor. I mean, if we see, and there's been a number of celebrities, and I won't mention any names, but celebrities and athletes that have sponsored SPACs. What do they bring to the table? Name recognition? I mean, really nothing, to be honest with you. Whereas a tier one healthcare dedicated hedge fund, which, by the way, just for folks these are huge organizations with massive amounts of capital now, in many instances dwarfing venture capital firms. And they're used to picking companies that will perform well in a public market, right? That's what they do. They're experts at it. So it really is about finding who is a sponsor. Once the investor roll from the IPO or shareholder list is publicly available. You can look that up and understand who came into the SPAC and who owns it. But the first screen would be who's the sponsor? Is it a tier 1 dedicated hedge fund, healthcare, healthcare dedicated hedge fund? How much capital is there? Is it the appropriate amount of capital that matches your needs and perceived valuation or desired valuation? That would be my first screen. And then getting into them or getting in touch with them, I'd use every contact I have. If you're a CEO or a CFO that has been at a public company or even a private company that's made people money before or made investors money, use your own personal contacts, use your law firm for possible introductions, use banker relationships for informal introductions. And then you could, of course, hire a bank if you chose to do that as well.
Yeah, and
I always say to our clients, sorry.
Oh, go ahead. Do you want to go, Rachel?
Oh, no, go ahead.
Okay, I was just going to add, John, as far as I know one of the questions was resources outside of there's many resources. I know going through the SEC and finding all the S1s might be cumbersome for some, but it is a path. But there's a number of different websites that's out there tracking the SPAC S1s as well. If you do a quick Google search, you can find them. I won't say names because I don't want to endorse one particular database versus another, but they are out there on the market. And what John is saying about making sure you understand who's on that management team, that sponsor team, is very important. Not only because that's what the SPAC used to raise money through the IPO process, but you also need to think about post-close. If you need to access additional capital post-close, having a really connected management team and sponsor team that you can still reach back out to after that deal has closed with them to gain potential access to more funding or more resources is also important. That's why the celebrity aspect is not so much what I would focus on. I would really focus on that management team and their expertise in your field.
Yeah, I always say all SPACs are not created equal. There is, a big difference between what I'd call the Class A SPACs with the really, great investors and investor base, and maybe some of the lower level SPACs. As well as, in the beginning, sponsors were always getting sponsor shares and warrants. And I think we're seeing some of the SPACs now not have warrants. And so evaluating that as well. So I just think, sometimes evaluating the offer from the SPAC is more difficult than you think it might be if you're not prepared going in.
And Rachel, you mentioned earlier, and there's a question just here about as far as cash expense from a de-SPAC process. And I know we don't have stats. You mentioned something about, as far as the price of the process, right, being cheaper. Is that generally tied with just the shorter time frame?
The shorter time frame, and you don't have as much time spent on probably the proxy and the S4 as you do on an S1, because you don't have the iterations of the drafting session, for better or for worse. So it can be cheaper from a legal standpoint than an IPO. You do have the merger agreement, although the negotiations on that are pretty standard and usually, are not terribly difficult. But we're not talking 50% of the cost. I think we're talking, 65, 70 to 75% of the cost of an IPO.
And Brian, I saw a question come in twice about when can SPACs actually start searching for the target. They're not supposed to start searching for the target until after the IPO is completed. So at the time of the IPO, a target should not be identified, and that is stated in the S1 document for all of those SPACs as well.
Great. Thanks.
I saw that question twice as well, and just to put it in context, a hedge fund or a venture capital fund that has a private portfolio company cannot go form a SPAC and then with the kind of premeditated idea of putting their portfolio company into it. That is not how that works. That is not allowed.
There was one last question about, Rachel, you mentioned some of the warrants, or some of the SPACs are no longer have the warrants. And is there any instrument that's replacing that, or what's driving that?
No, I mean, I'd be curious on John's thoughts as well. I just think some of the higher level SPACs are just doing the 20% sponsor shares and not necessarily giving all the warrants. So I saw some data the other day just on how that trend is decreasing so that it's more attractive to target companies so that they don't have the warrant overhang. John, I don't know if, what you're seeing on that anecdotally.
Yeah, it's interesting because we did see they traditionally come with some level of warrant coverage. We did see them go away. We are starting to see the new ones that have priced come back, albeit with less warrant coverage, with kind of quarter warrants or third warrants versus half or full. So it's a little bit of a mixed bag because I think these are such highly sought after vehicles. The sponsors are now kind of back to thinking, well, I can get away with some of this.
Yeah, and then during the deal now, what we're seeing is that some of the sponsors are also agreeing to give up warrants for the ones that gave away one warrant to start with. They're now forfeiting some warrants as part of the deal as well, in addition to putting up some of their shares in an escrow account to be re-earned later.
Yeah, with that, we're seeing that too, the earnouts for some of the promote shares as well as some of the warrants that they have.
So as we're moving into the last few minutes here, a couple last questions, and I thought maybe I'd ask each of you these questions, but we have a large audience of life science companies here, and maybe just what are some common characteristics of life science companies that you've seen or that you've worked with that have had successful public offerings, whether it's via SPAC or via IPO?
I'll start. To me, it's the same characteristics, whether it's a SPAC, a crossover, an IPO, right? It's obviously backed by, either good science and good data, preclinical data. I mean, obviously that's kind of first and foremost is that they have the management team, a management team that's experienced, that presents really well, that they present their strategy and are organized and prepared when they're going into the process. I think that, as I said before, and I always say this to my companies, you just can't underestimate how much that can impact your value, how much it can impact the process, how much it can impact every aspect of what you're doing. So I think the more that you can be prepared with that and get input before going into it. And then finally, don't be defensive about the input that you do get. I sometimes see CEOs who we sit in these drafting sessions or we go through some of the presentations and just fight back on every single change, or it has to be their way. And I just think there's a lot of people sitting around that table that have seen tons of companies be successful, seen where they've fallen, taken the advice, make sure that you're listening to what you hear, because often those themes that you hear in the beginning that you may or may not listen to will come back up on the roadshow, will come back up during valuation. So I think it's really, where I've seen companies be successful is these great management teams who have a, great company, great story, and then can take in the advice, can adjust, and really just make it, the best possible story that they can have.
And I'll pinpoint the one thing in Rachel's feature that I find also is the common theme is going to be the science of it all, is what I say. At the end of the day, what you're putting on the market, everyone's going to judge that and your product. That still matters in the SPAC world. It still matters. So I call it the science of it all. It's what are you selling, and what is the trajectory and the projection for what you are selling me as an investor? And that's dictating your success on the market once that company now goes public.
That's a good segue to my thoughts, and I think everything that's been said is spot on. From a therapeutic category, we still are seeing incredible activity in cell therapy, targeted oncology, genetic medicine, rare disease. But to Condola's point, I would just let everybody think, don't take shortcuts, right? Really anywhere. And we understand that, folks at companies are scientists and they're incredibly brilliant. But don't take shortcuts, whether it be on the legal side, or it be on the accounting side, or in the lab itself. The investor base that you're going to be dealing with are incredibly sophisticated. Many of them are physicians, many of them are scientists themselves, and they look at science and data all the time. They will find problems if there are problems. So don't underestimate the audience.
I will ask one final question. There was one more that came in just about, I think, kind of the mechanics of it, right? So how much cash, would a target receive from a $100 million SPAC after all the transaction fees, assuming no PIPE? Can you hit that one, Joe?
Yeah, I mean, it's going to be, and Rachael touched on it as far as on the vendor side or the service side, it's going to be, 60, 70% of what your IPO cost would be. If you hired a banker, it'll also be less than the 6% that you did on an IPO. However, it's not zero, right? So if it costs you, let's just say you do a $100 million IPO, and that's $2 million in service fees between your underwriting counsel and accounting, printer, and then you have 6% or 7% on the bankers, right? That's $9 million. It'll probably be somewhere around 5 or 6.
Okay.
So you're going to net whatever, 93 or 94, 95.
Yeah, and there was another question here too. Can a SPAC merge with more than one company?
Yeah, great question. And philosophically, we're all talking about this. Technically, they can, but you can't have more than one closing. So that's where things would get complicated, or very complicated. Condola and Rachael may have an opinion here. We've been talking about this a lot, right? If there's multiple targets, can one SPAC go and kind of gobble those up? I think theoretically, yes. How to do it is not yet known, really, because sequential closings I don't think would work mechanically.
Yeah, agree, John. There's been a few that I've worked on, maybe a couple of them, and there are some accounting complexities that you'll need to consider. We don't have enough time to get into that, but it is possible. It just becomes a bit more complex, not only from the story that you're telling, but from the accounting side, the legal side. I'm sure Rachael can hit on that, but it is possible. It just becomes more complex.
Yeah, from the legal side, it's all about how you structure it, and when you do that acquisition, and as John said, you don't want more than one you can't have more than one closing. So maneuvering around that, and we could probably have a separate call just to go through the structuring considerations for it and the legal and financing or accounting implications.
And that would be super interesting too.
Do you want to stay on for 2?
Well, thanks to all 3 of you. As we end here, we have a couple minutes. Any final words of advice for all of our BioBreak members that have joined us here today as they're thinking about possibly a SPAC or IPO transaction in the next 12 to 18 months?
As you're thinking about one, call EY. There you go, Brian.
There you go.
Yeah, I mean, I gave my advice about not taking shortcuts earlier. But I would just say, in the spirit of Condola's comments, happy to talk to anybody, irrespective of stage of development. So feel free to reach out.
Rachael, your final commercial?
Yeah, happy to talk to anyone about the pros and the cons. I think don't take the shortcuts and recognize that it's not going to be a quick fix. I think sometimes people expect a little too much out of a quick fix from a SPAC. Got it.
Well, thank you to all 3 of you for participating today. Thanks to BioBreak for putting this on, to Laura and Sam for helping out here, and thanks to everybody who joined the call today. Again, if you have questions or need information, you can get our contact information through the BioBreak folks. So thanks for the time today, and look forward to hopefully meeting all of you in person at some point soon.
Thank you so much.
Everybody.